Okay. So income approach is known as discounted cash flow or present value analysis. The income approach and the asset-based approach are termed absolute valuation models. Okay, the income approach and the asset-based approach are termed absolute valuation models. Okay. The income approach and the asset-based approach are absolute. Can you understand this line? Why they are calling it absolute? Because you are not comparing with other competitors.
It's not relative.
Yeah.
In relation to, it's not in relation to something.
Yeah. Income approach. Just you quickly go through all this, whatever I have highlighted. The free cash flow method, also known as the discounted cash flow method. So this income approach. So income approach means free cash flow, and then capitalized cash flow method. So capitalized cash flow is nothing but Gordon growth style only. See this one, capitalized cash flow. What do we do under Gordon growth? D1 by R minus G, na?
R minus G.
So here the D1 is taken by FCF of 1 divided by WACC minus G.
Yeah.
Okay, so we are taking WACC over here because it is for the entire firm, value of the firm. Okay, so it is similar to Gordon growth model only. You can just go through all these highlighted words.
Sir, can you explain this? A series of discrete cash flow or forecast means they are forecasting the cash flow basically.
Yeah, a series of discrete cash flows are forecasted plus a terminal value. Terminal value is what, from where constant growth is happening.
Growth will start.
That reflects the value of the business as a going concern at some future date. So this is just Gordon growth model, na?
Okay.
Dividend, and then that's how we get, right? See. And then from here on, constant growth. So this is terminal value.
Sir, how can we use price multiple to estimate the firm's terminal value?
If the price multiple for a firm in a high growth industry, the price multiple applied will often reflect high growth. Remember the residual income model we did the last part?
Yeah.
So there at the end we applied the price multiple, right? Price to book value.
Yeah. Got it. You can scroll, sir. Under this method, a single measure of economic benefit is divided by the capitalization rate equal to the required rate of return minus growth. This is basically for Gordon growth, na?
Yeah. Yeah.
You can scroll, sir.
Proxy of is not needed. Wherever you see proxy, you can leave. Okay, they will not ask you proxy kind of thing.
Okay.
This is again value of equity. So FCFE, expected FCFE divided by R minus G instead of WACC. Okay. This is a very simple sum. Capitalized cash flow method. Let's go through this question.
Yeah. Sir, I'll try this.
So FCFF in 1 year, growth rate, 4% WACC, and then market value. So what is the question? Calculate the value of the firm. So value of the firm is FCFF in 1 year. Okay.
So, in this, sir, market value of debt is given.
Value of the firm. FCFF 12. And then 000 WACC minus G. WACC is 15% minus G. Growth is 4%. Just
Sir,
calculate
there is
this.
someone on the door. There is someone on the door. I'll just open it. Hello.
We're calculating, right?
Yeah. Yeah. Sir, why have they given us value of debt in the firm? What is the use of that? Sir, it's 1.1 million.
Hello.
Hello. Hello.
Hello.
Can you hear me, sir?
Hello.
Hello.
I'm not able to hear you.
Hello.
Hello.
Sir, can you hear me now?
Hello.
Hello. Hello. Hello. Hello, sir. Can you hear me? Hello.
Hello. Okay, I'm not able to hear you. I'll just reconnect quickly.
Hello.
Can you hear me now?
I can hear you, sir. Hello.
Okay. Yeah, I can hear you. Yeah. Okay. Have you done this one? Value of the firm?
Yeah, yeah. I'm doing it again. Sorry, sir. That I just
Okay. No.
I'll just do it.
Hmm.
110 million.
That is the value of the firm.
Hmm.
The next one is value of equity. See, value of equity when they ask, and value of market value of debt is given. See, value of equity, multiple formulas are there.
Okay.
Value of equity is equal to free cash flow to equity expected one divided by R minus G.
Yeah.
Okay, that is also there. But then here, because market value is of debt is given, if that is
Huh.
given, value of equity is equal to uh, uh, value of firm minus market value of debt.
Hmm.
So 110 million. Market value of debt is 4 million. Calculate.
106 million, sir.
So this CCM means capitalized cash flow model is what? Very similar to Gordon growth only. Okay.
Yeah.
Uh, note that the capitalization rate in this example, capitalization rate means this one, okay? R minus
Hmm.
G is called capitalization rate.
Okay.
So this is capitalization rate
Okay.
here. Capitalization rate. In this case, WACC minus G. 11%. The WACC will be
Yeah.
greater when more equity and less that is used. Okay. Resulting in lower estimates of the firm and equity values. Okay. Yeah. Excess earning method. Just
Yeah, I'll just read.
I think if you do the sum and then read, you will understand better.
Okay, I'll do the sum, sir.
The values, intangible assets, and just read. You will not understand fully. Just read. Then we will do the sum. Then again you come back and read. Then you will get
Okay.
it.
The analyst starts with the earnings that should be generated by working capital and fixed asset
Hmm.
based
Now,
on the estimate of the required return. Excess earnings are the firm's earnings minus the earnings required to provide. No, I did not get it, sir.
yeah, yeah. Now we'll do the sum. Then you come back and read. You will understand.
Okay.
Calculating firm using the excess earnings method. So excess earning method. Under the excess earning method, the analyst starts with the earnings that should be generated by working capital and fixed assets based on the required return. See, in your company, you have working capital and fixed assets. So there will be some required return. That means if you are investing 1 lakh rupees in fixed capital, how much you are supposed to generate returns for that because of fixed capital.
Okay.
Then you are investing, let's say 30,000 as working capital. Then how much you are supposed to create returns because of that working capital. And overall, how much are you creating return? That we will see now. See.
How can we create returns through working capital?
No, everything will have, you can convert all into cost, right? 1 lakh rupees you have invested anywhere. You have invested. That means, let's say 10% is the cost of capital. So with that fixed assets, you are expecting to generate some 10% revenue. Okay.
Through fixed
We'll see
asset,
that.
I got it that we are getting revenue, but working capital is something we use to run business, na?
Fine.
So
So
how can we?
whatever profits you are getting, you can allocate some part that because of this this is for working capital.
So
This
okay,
is
so
for
we
fixed
had
assets.
excess working capital or sufficient amount of working capital, and through that sufficient amount of working capital, we got some results and we got profit.
Yeah. See, given the following figures, calculate the value of the firm using EEM. EEM, okay, excess earnings method. Now, see, just go through this question. Working
Yeah.
capital 3 lakhs, fixed assets 1 million, normalized earnings just year ended 130,000, required return for working capital 6%, required return for fixed assets 10%, growth rate of residual income 5%, and discount rate for intangible assets 14%.
14%.
Okay. So required return for working capital 6%. Fine. And required return for fixed assets 10%. Growth rate of residual income 5%. Discount rate for intangible assets
14%.
14%. Okay. Now you see this one. First of all, working capital is 3 lakhs and required return is 6%. So that means working capital perspective 3 lakh you invested and it is supposed to give you 6%. Just calculate 18,000, right? Similarly, fixed uh, fixed assets 1 million into 10%.
And
10,000. Okay, so
10,000, sir, 1 lakh.
it's 1 million. Acha, 1 lakh. 1 lakh. Okay, and your earning is earning 1,30,000. So earning is 1,30,000. So excess earnings
Hmm.
is equal to 1,30,000 minus 1,18,000.
1,18,000.
This is 1 lakh. So 1,18,000.
12,000.
12,000. Right. Yeah. So this 12,000. Yeah, 12,000. Okay.
Hmm.
Uh, Now you see growth rate of residual income. This 12,000 is the residual income for you.
Hmm.
Now it is growing at the rate of 5%.
5%.
Okay. So residual income is growing at the rate of 5%. Okay. So which comes to this step. This 12,000 is growing at the rate of 5%. Just calculate how much it will be.
12,600.
So 12,600. Okay, this is growing at the rate of 5% means you apply that uh, Gordon growth model only. Okay, using the
Acha,
formula
हाँ,
for
okay.
growth perpetuity. Now
Okay.
this excess amount you will attribute it to intangible assets. Why intangible assets? Because intangible assets. So this is, remember last time we were speaking about that financial reporting there, intangible assets. See,
Yeah, goodwill. Yeah,
goodwill. So
yeah.
company required return company has generated.
हाँ.
So if you think from balance sheet perspective, working capitals required return company has generated,
Hmm.
fixed capitals required return company has generated. But
Hmm.
further, if it is getting more, it is because of the goodwill of the company.
Hmm. Hmm.
Okay, or the intangible assets.
Hmm.
So this I will attribute it to intangible assets. Okay,
The excess
divided by
5% that we got.
yes, excess amount 5%, and this excess amount,
Okay.
and which is growing at 5%.
Yeah, okay.
Okay, now divided by WAC minus growth rate. So 14% is the discount for intangible, not WAC, sorry, discount for intangible assets.
Hmm.
So intangible assets minus 5%,
9%.
intangible growth rate.
12,000.
Okay, this is required return for intangible assets minus growth rate of 5%. Just calculate this.
1,40,000.
Okay, 1,40,000. Okay, all
Yeah.
right. So 1,40,000. Okay, and so firm's value is what now? Firm's value will be, so working capital.
Sorry.
So working capital, fixed capital, or fixed assets, and then this is intangible value, assets value. So working capital plus fixed assets plus intangible assets value.
So working capital is 3 lakh
Working
plus
capital,
1 million. We will also add net profit, na?
working capital. So we are valuing the firm now. Okay, that profit all we have segregated, right? We have distributed between working capital, fixed capital, and intangible assets. No? So working capital was 3 lakh,
3
and
lakh.
this is what, 10 lakh.
No, it's 3 lakh and 10 lakh. Yeah.
3 lakh, 10 lakh. Yeah.
But then why are we not adding net income?
Okay, 3 lakh. Okay, wait, I'll tell you. Plus 10 lakh. We are valuing the firm now. We are not calculating the profits.
Okay,
What is the value of the company? So value of the company is this much.
14,40,000.
Okay. The value
14
of the
lakh 40.
company is this much. 14,40,000. Okay.
Hmm.
Now, under excess earning method, the FCFF may be given in place of normalized earnings. The growth rate in FCFF, see, FCFF may be given in place of normalized earnings. So all these are possible.
Hmm.
Okay. Somebody will not be comfortable with this. They may want to use FCFF only. The growth rate in FCFF may be given in place of the growth rate of residual income. So all these changes are possible.
Okay.
After these substitutions, the calculations are identical to those listed previously. Okay. These are different ways now. Now, which method to use, that depends upon the circumstances, depending upon what kind of company you are operating, all
What
those.
information do we have?
Okay. This
Yeah.
should be used when probably the assets of the company is less, let's say like something like IT company or so,
Hmm.
where intangible assets may contribute more. Your intangible assets could be your employees there.
Hmm.
You are not going to show that employees as the assets, right?
Yeah.
This is okay till here.
Yeah. Yeah.
Then yeah, it's over almost now. Market approaches. Calculate the value of a private company using market-based methods and describe the advantages and disadvantages of each method. Okay. Public guidance, public company, guideline public company method. So guideline public company method uses enterprise value multiple for public companies with adjustments to multiple to account for difference in size, leverage, and life cycle stages between the subject firm and the comparable. That means similar to that levered unlevered. You are getting inspired from your
Okay.
public company.
Public company.
So when it was acquired,
So
what
we are
was the
using
enterprise
public
value?
company as proxy basically.
Yeah, proxy. And then you will do all the adjustments because of the size of the company, leverage, life cycle. You will do all the adjustments. So your guideline is provided by the public company. So now all these are very highly subjective. Difference in size, leverage, all this, it's a negotiation finally.
So how will we
Negotiation.
adjust the company basing on the life cycle, basis on the life cycle?
That's why
So,
it becomes little subjective. What is the tailwind of the company? What is the growth rate of the company?
okay,
Okay.
okay.
What is the future scope of the company? What is the cash flow that it is already generating? Okay. So to estimate the control premium, a public transaction should be used where your firm was acquired, and the following issues should be addressed: transaction type, industry conditions, types of consideration, inflated bubble is there or not, okay, reasonableness. These are all, it becomes little subjective then. Okay, multiple industries. What is the multiple going on in the industry? When using comparable based approach, a private company operating in multiple industries should be assigned a weighted average multiple
Okay.
based on the proportion of revenues generated in each industry. Okay. Mhm. One minute.
Yeah.
Yeah. So multiple industries, when using a comparable based approach, a private company operating in multiple industries. Acha, multiple industries. Okay, company is into multiple industries itself. It's not multiples, multiple industries. A private company operating in multiple industries should be assigned a weighted average. Say, for example, one company like Reliance is into multiple industries, right? So how much weight you want to give to each sectors that they are into?
From
So
the
it is
revenue
weighted
that they are
average
getting.
multiple.
Yeah.
Okay. So what is the exposure towards different sectors? Like Geo, their exposure is going up. Then towards oil and energy, their exposure is coming down. So accordingly.
Yeah.
Okay. Now you can go through this sum now.
Yeah.
These are all just highly, see, this is just, it's a very self-reading only. You just go through this sum. It's hardly 1 or 2 sentences only. Just that they have given weights. Just go through the question. Nothing
Yeah.
else is there in the question. Just go through it.
Got it, sir.
Yeah. Okay. So you are able to understand this?
Yeah.
Okay. So all they have done is just 70% revenue. So
From
70%
computer,
weight.
yeah, 70
20%
percentage
weight
revenue
of
and
this multiple. So here 20% weight and 10% weight. So
yeah.
based on the revenue, weights has been given. Okay. Then this is enterprise value multiple. Okay. EBITDA into multiple will give you enterprise value. Okay. The sum is okay, right?
Yeah, yeah, yeah. Very much.
The next one, guideline transaction method. These are all the very thin line between all these things. First one was guideline public company
Company
method. That means you are taking inspiration or proxy
of a
of a
public
public
company.
company.
Yeah.
Guideline public company method. Second one is guideline transaction method. Guideline transaction method. Okay, so guideline transaction method. So this is GPCM and GTM. So under when using the guideline transaction method, prior acquisition values for entire companies are used. These acquisition
Under
value
what? Prior acquisition value for it.
transactions, no guidance, transactions. You are using prior transaction as the guidance. Prior
Okay,
acquisition
yeah.
values for entire companies are used. These acquisition values already reflect any control premium, so no additional adjustments for a controlling interest is necessary. Although data about the sale of public companies is readily available, availability of information about the sale of private firms is more limited. When using multiples from historical transactions, so here basically private, public, all transactions are used. So private, so acquisition values of both public and private companies will be used. Okay. The rest is all theory only. So transaction type, prior transaction may be a strategic transactions or not. Okay. Then contingent consideration. Contingent consideration refers to that part of the acquisition that is contingent on the achievement of specific company's targets. Then some acquisitions are made with stocks rather than cash. So all these will be factored in.
So can you explain contingent consideration? I did not get it.
Such as, see, that means let's say some approval is pending. Let's like they have mentioned here. So companies at the stage where some approval is pending. So if it gets approved, the value of the company will go up.
Go up, yeah.
So accordingly, the valuation will be done.
Okay.
So that means some other pipeline order book will be there for the company. That also will be factored in. No? Some tender they might have applied for which they are about to win. All those also will be factored in.
Got it.
Okay. Just go through this. This is also easy one only. Sums are all easy only. You will get all theory only in this one. Okay. $7.2 is the average EV EBITDA. Okay, and then they are applying 30% discount. So minus 30% discount, 5. Okay, so EV multiple is equal to EBITDA divided by enterprise market value of the company, market value of no, this is enterprise value divided by EBITDA. Right, that is the formula. So on this basis they have calculated EBITDA. So EBITDA is equal to this is EV by EBITDA. Okay, so the multiple is 5. 5. Now they are earning. Okay, we are calculating value of the firm, right? So value of the firm is 18,200 into 5. So 18,200 is the EBITDA. Okay, on this basis, 5 times they are ready to pay. The market is ready to pay. So this is the value of the firm.
Yeah.
Okay, 5 times the market is willing to pay. That means if they pay this much, it will take 5 years for them to recover the money. Every year, company will keep paying 18,200 in the form of EBITDA, and it will take 5 years for them to recover all the money. Fine, okay. Is it over? I think. Yeah, it's all done only.
Yeah, it's done.
Over, yeah. Okay. So now this is okay. The equities 1150 now. So